Hello, this is the Unemployed Value Degen. This is not financial advice. You have to do your own due diligence. But more than that, today I wanted to talk about some option strategies. And options require a little bit more of a disclaimer. It's not just that for regulatory disclosures, things like that, you should do your own due diligence. Most people shouldn't do options. Options have a steep learning curve, and the losses can be pretty steep. So for most people in their lives, they're better off not using them. If you want to pay that market tuition and eat your own mistakes and learn how to use options, you can do it, but it's not a good idea. So I'm not just saying, hey, this is not financial advice. I'm saying don't do this. Don't trade options. It's just not a good idea for most people because the upfront cost of learning how to do it and making those mistakes is it's a lot. And the benefit afterwards, I enjoy it, but I've made a lot of mistakes along the way, and I don't wish those mistakes on anyone else. Today I want to look through the companies that I'm interested in and see that even though the market is pretty elevated right now, the strategy that I use to generate some income to buy a few more shares of stock every couple of weeks is I sell puts. Now there's two kinds of options. There's calls and puts. Calls are a right to buy and puts are a right to sell. In every option, you can be the buyer of the option or the seller of the option. So for puts, you can buy the right to sell or you can sell the right to sell. It gets a little messy and complicated. But what I wanted to show you before I get into that is this is not a good time. It's not a great week to be selling options. I have the fear and greed index pulled up, and it's pretty close to neutral. It's not too extreme one way or the other, but it breaks into some subcomponents. And market momentum, how high is the market above its 125-day moving average? The market is moving up. It's been moving up all year. Then you have the strength of the moves, the breadth of the moves. But for options, the important ones here are the put to call ratio. So right now, people are out there buying calls. People are buying the right to buy. People are buying lottery tickets. Say if the stock market goes up, I want to make a lot of money. They're not buying a lot of puts. Puts are the insurance. If you own the right to sell it, suppose you own 100 shares of Apple and you own a put on Apple. Well, if the stock price of Apple crashes, you have the right to sell Apple at a predetermined price, so you have downside protection. People that buy puts are buying hedges. They're buying risk management. And right now, nobody's buying puts. So it's a bad time to be selling them. And then on top of that, you have the volatility index, the VIX. And the VIX is getting a little low. So not only are people not buying puts, but they're not spending a lot on options. Generally, options are kind of cheap right now. You want to sell things when they're expensive. You don't want to be selling things when they're cheap. So this is not a fantastic time to be selling options generally, but so I'm not going to go overboard. I'm not going to go crazy and do a lot, but I do always sell a few every couple of weeks because I want some money coming to the account to buy a few more shares. Now, let's see. Let me look at Peabody Energy is having a big move today. It's fallen from it's down $2.16. It's fallen from $27.40 all the way down to $25.25. It's down 7.5%. They just announced that they're going to be buying the coal assets of Anglo American. The market did not like the news because that means less money towards share buybacks. I actually am not so negative on the acquisition over time. It's metallic coal assets, but the market doesn't like it. Well, if I wanted to sell a put on Peabody Energy, I'm selling to somebody else the right to sell the stock back to me. So what that means is they're going to pay me a little money now, but they can make me buy Peabody Energy. Now, I like Peabody Energy. I want to buy Peabody Energy. I don't know if I want to buy it at this price. The 200-day moving average is still down here at $24. This chart could fall further. Let me go and see what the prices are for these options. So the really nice thing about Peabody Energy is they have weekly options. So I can see what's 1 week away, what's 2 weeks away, 3 weeks, 4 weeks. Some stocks have options that are thinly traded, and they don't have weekly options. Another thing that's nice about Peabody Energy is the strike prices. So the stock is currently trading at $25.26, but there's strike prices every 50 cents. So there's one at $25, $24.50, $24, $25.50, $26, $26.50. So the strike prices are really fine, and the volume is pretty good, and they have weekly options. So Peabody Energy is it's a nice stock to be looking at options for. But if I want to go out, say I'll go out to, you know, the end of the month so that the comparisons between some other companies I talked about today are fair. If I take this current $25.26 strike price, suppose I commit, say I'm willing to buy Peabody Energy at $25. That for the next month, whoever buys these options could force me to buy Peabody Energy at $25. Well, I have a bid-ask spread between 77 and 82, so I could probably get paid 78 cents a share today. Now, options are always done in round lots, so I have to commit to 100 shares. If I sell one put, I'm committing to buy 100 shares of Peabody Energy, but I could get paid 78 cents a share for 100 shares. That's $78. So I have to be willing to commit $2,500 to buy shares of Peabody Energy, and I could get paid about $78 right now to do that. You see that this contract has some volume today. A lot of people have taken them up on that offer. A lot more people have taken them up on this offer to buy it at $24. And I'll go back to the chart and show you why. So if I do accept $78, that by the 20th of December, somebody can make me buy Peabody Energy at $25. Well, I still have the $78 I sold it for, so I'd essentially be at that point, if it triggered, I'd be buying Peabody Energy at $24.22 a share, and I'd buy 100 shares if it triggered. If it didn't trigger, well, I would just keep the $78, and after this option expires, that money would be in the account, and everything would be hunky-dory. The yield on that, right, $78 out of 2,500, that's a little over 3%, which is not huge as far as options go. 3% in a month is a very high yield, and that annualizes to 36% a year. It's a fantastic yield. Plus, if you have cash to buy this stock, you're going to get paid the money market rate of another 4%. So you'd be making 40% a year if it doesn't get triggered. If it does get triggered, I hope you like Peabody Energy because now you own a lot of it. What I find interesting is that this strike price has some volume, but the $24 strike price has about 10 times as much volume today. And that's interesting because they're not paying you nearly as much. Right now I could get about 42 cents promising to buy Peabody Energy at $24. Well, 42 out of 24, that's only about a 1.75% yield. However, if I go back to the stock chart, $24 is the 200-day moving average, which is a pretty good resistance line. And if I get paid 42 cents to be willing to buy it at $24, the price would have to fall down to about $23.60 before that would get triggered. And the technicals make it look like $23.60. Well, in a lot of ways, let me go to this graph. This might actually be kind of a smart trade. So that line, $23.60, which again would be selling a put for December 20th at a strike price of $24, getting paid, we just updated the information, so getting paid maybe 39 cents to do that. So this would get triggered at $23.60. If I annotate this chart, $23.60, it's about here. That's past a resistance line, right? The stock price had a hard time breaking above that. And one aspect of technical analysis is that past resistance becomes the new support line. And there are psychological reasons behind that. But as far as the technicals are concerned, this is a pretty good option. The yield is only about 1.75%, but the stock price would have a hard time falling below that. So when you're selling options, it's often referred to as picking up nickels in front of a steamroller. I mean, could the price of Peabody Energy fall to $20 a share? It was there in September. It absolutely could. It's just not very likely to. So if you wanted to pick up nickels in front of a steamroller on Peabody Energy, what a lot of people are doing, so they've exchanged 3,100 contracts today for this. This is a pretty popular option. And there's open interest for 700 more. You could get paid about 38, 39 cents a share to promise to buy Peabody at $24 a share. One contract is for a round lot or 100 shares. You have to be willing to spend $2,400 to buy Peabody Energy. And if you're willing to spend $2,400 buying Peabody Energy at that price, you could get paid about $38, $39 today. So that saying, picking up nickels in front of a steamroller, it's real. Right? You're getting paid 38 bucks to promise to spend 2,400 when you're selling a put. But it's not a terrible bet, right? That past resistance becoming future support, I think the stock price would have a pretty hard time falling below $23.60. So there are professionals that are doing that, but they do a lot of analysis. And this is not the sort of thing for a casual hobby. Again, and this is not only not financial advice. I'm actively telling you, don't do this, right? Your life is probably better off if you just say, you know what? I've done my fundamental analysis on Peabody Energy. I think metallic coal is not going anywhere for a while. I think that there's a very hard time to generate enough electricity to generate all the steel you need on these electric arc furnaces and to get the quality that you need. So you don't have, the recycled steel generating inferior product. We're decades away from that. And metallic coal for steel uses is going to be around for a long time. I think Peabody Energy is a good company. I want to own it for the next 5 or 10 years. Well, then buy some. If that's your attitude, and you look back and then say, well, I'd like to buy it, but I don't want to buy it at $25. So, hey, if I sell this put and it gets assigned to me, then I bought it at $23.65. Well, you can do that, but in that world, you're not picking up nickels in front of the steamroller. You're not doing it to get $35. You're doing it to get a better entry price on the Peabody Energy that you want to buy anyway. And in that world, if your option gets assigned, you're happy because you wanted to buy Peabody Energy. In the world where you're doing it to make $35, risking $2,400, you don't want the option to be assigned. You want it to expire worthless. So again, this is not only is it not financial advice, just don't do it. It's probably not going to be a big value add to your life. If you're a professional, if you have a career, if you have a day job, this is an expensive hobby, right? This is a steep learning curve where a lot of mistakes get made. I'm not going to open a position in Peabody Energy at this price. I like to find situations where, now coal is a trump trade. Coal might have a few great years in front of it. I like to find something a little bit of a higher yield than 1.75%. And I do not like this $25.50 strike price. So I'm not going to write any options on Peabody Energy today. That's just me. But a lot of people did, right? There's a lot of people, and you got to imagine, hopefully they're professionals, hopefully they're smart and they know what they're doing. A lot of people wrote a lot of these options today. I'm not. I'm going to pass on this one. I'm going to look through my portfolio and see which stocks I want to own more of. Because for selling puts, you have to be prepared that some of them are going to get assigned. And when they get assigned, it should be a happy event. It should be a stock that you want to own more of. And then if it doesn't get assigned, well, you just make a little bit of money, and that's fantastic too. Before I do that though, the last couple of videos I made, I took a look at this 10-year Treasury. And the move today, after the announcement of the new Treasury Secretary, this is an enormous move downward in interest rates. Let me go back to the 1 month. So the first time I did a video and I pulled up this graph, the 10-year Treasury was here at about 430 something. I said, well, is this going to be the peak, or is it going to start falling? And no, there was a higher high. It was at about 440 something. I said, well, is this going to be the peak, or is it going to start falling? And no, there was a new higher high, about 445. And it was only with the announcement of this recent Treasury Secretary that you really have this relief in interest rates. So if I go back out to the 5-year trend, we're in a cutting cycle. The central banks of the world are all cutting. The United States is cutting, but we're a little slower to the cutting than some other countries. We were faster to raise interest rates, slower to cut interest rates. But I think that this is about the interest rate path, that the interest rate is going to, most market participants believe that interest rates are going to go through this channel for at least the medium future. Maybe the first 2 years of the Trump presidency, or maybe there will be a trend reversal at some point within these 2 years. But if we have a 10-year Treasury that, say, is somewhere around 3.5 by the end of 2026, there's a chance that the 30-year mortgage rate could be attractive to thaw out existing home sales. So this is a powerful trend to keep an eye on. And while the S&P 500 was struggling, while there was some doubt whether this kind of struggle area of the S&P 500, a lot of that was because there was some serious doubt as to whether we're going to be back on the downtrend here, short-term higher high, and a higher high. That was making a lot of people very nervous. But if this long-term pattern holds, if this is what interest rates look like for the next couple of years, that could be one heck of a stock market rally. Because remember, the interest rates are like gravity to the stock market. And declining gravity means you can bounce a lot higher. And then connected with this is the strength of the dollar index. And the dollar index has been, for the last year and a half or so, bouncing around this channel. And it was reaching new highs. It was getting pretty scary. And I have a few themes that I write about on my Substack. One is sustained inflation. One is the revenge of Cathie Wood. Is small cap tech going to break out? And one is a rotation out of the US dollar back into international stocks in the emerging market. And a strong dollar is a threat to that. I think, and I talked about Ecopetrol, the Colombian oil stock. I talked about PagSeguro, a payment processor in Brazil. My belief was that Trump was going to pursue competing devaluation in order to boost middle-class wages. And the new Treasury Secretary seems to want to throw some cold water on that we might be having a strong dollar policy in the near future. So if Trump is pursuing a strong dollar policy, then the dollar index, it might break out of this sideways channel. This channel might not be the path forward, but interest rates and currencies. So when your interest rates are higher than other people's, your currency tends to strengthen. When your interest rate is lower than other people's, your currency tends to weaken. There's also economic growth is a big part of it. But the US dollar might break out of this trend line. And so my pivot to South America and Brazil and Poland and a couple other places, that might be a year or two early. Now, in the short term, we might be reversing here. But I think, sometime in 2025, I wouldn't be surprised if it doesn't reach the bottom of this channel but bounces earlier and makes a new high outside of this channel. I think that's something to watch for in 2025. So I'm not going heavy into, I have a starter position, Ecopetrol and PagSeguro, but I'm not going to write any puts on them today. I think I might be early in that. I might be a year or two early. So strong dollar and maybe some falling interest rates. And a market that is, in some ways it's toppy, but in some ways it's not. So the S&P 500, the median PE, price to earnings ratio of the stocks outside of the Magnificent Seven, that's a 17, which is somewhat expensive. We also have higher sustained inflation, which is nominal growth. So if you kind of inflation adjust it, it doesn't have to be toppy. Now that might not be true about the Magnificent Seven, especially Nvidia's down a good chunk today. Nvidia's down almost 4% on the day, and this is a $3.5 trillion market cap company. So when it falls 3%, that's a lot of money moving around the market. People are going to be watching what happens to Nvidia pretty closely, and all the Magnificent Seven stocks. But anyway, it's all right. So back to stocks that I might want to write a put on. I'm just going to start with my larger positions. So my largest position right now is Medical Properties Trust. Look at the chart. This is one that is not breaking out yet. Now the fundamentals keep only improving, and the short interest on this thing is just incredible. It's up to almost 43% of the float is sold short. Now, part of that is because a lot of it is held by institutions, and that's not eligible. So it's not 43% of all shares outstanding are sold short. It's 43% of the float, which is shares available. But that's huge, which means that this could suffer from a short squeeze, which we saw start in May and then collapse. We saw start in September and then give it back. At some point, this is going to have a short squeeze to a new high, and it's not going to give it back because under the surface, fundamentally, things have been improving. But that could be a year away. But in the meantime, I would be happy owning more at this price, right? So as far as where the resistance is and how far it can fall, this is not a dangerous thing. I mean, this is a stock that is trading at less than half of price to book for acute care hospitals. I mean, that's going to correct itself someday. So that's the kind of put that I would like to write, because if I was forced to buy more, I would be happy about it. The strike prices are every 50 cents, which is really good, and they have weekly options. So I could go out just 2 weeks to the 6th of December, and you know, I could get paid 24 cents, 23 cents to promise to buy Medical Properties Trust at $4.50 for 2 weeks. I really like the 2-week time frame, but I'm going to do the calculations based on the month, because a lot of the stocks, just to have even apples to apples comparison, it would be on a 1-month basis. I could get paid 39 cents per share to promise to buy Medical Properties Trust at $4.50. If that got triggered, I'd be buying it at $4.11, which is a price that I think is fantastic. I could get paid 18 cents to promise to buy Medical Properties Trust at $4. That one, if it got triggered, I would be buying it at $3.82, which is fantastic. And if I go back and I look at the chart, $3.82, the stock hasn't seen that price since April. Oh no, back there was a little bit in that dip in July, but nope. Hold on. No, it's not. I'm looking at the wrong line. $3.82. It hasn't seen that price since February. Sorry, that black line is a little hard to see, and I'm getting old. So yeah, the stock hasn't seen that price since February, and that's way before we had the resolution of the steward-tenant bankruptcy process. So that is a pretty darn low-risk option to sell. It's still picking up nickels in front of a steamroller. At $4.11, it has seen that price in July. So, but I still think it's, you know, would I be willing to buy more Medical Properties Trust at $4.11? Absolutely, right? That's a fantastic spot. It's a triple bottom, maybe a quadruple bottom. It's bounced off of that 3 or 4 times. So if I go back to the options, either one of those is reasonable. I could get paid till December 20th. I could get paid 39 cents to promise to buy Medical Properties Trust at $4.50. And if that did not get triggered, that would be an 8.6% yield, which is an enormous yield. That's fantastic. If it did get triggered, I would be buying Medical Properties Trust at $4.11, which is a price that I'm happy with. If I do this one and I get paid, call it 19 cents to risk $4, or $19 to risk 400, this is still a 4.75% yield to promise to buy Medical Properties Trust at $4, which after having received 19 cents is really $3.81. That is an extremely, from my point of view, having done my fundamental research on the company, really liking the stock a lot, to make 4.75% in a month for promising to buy something I like anyway, I think that's a fantastic put to sell. And this is not financial advice. And not only is it not financial advice, you should not do this, right? You should not experiment with options. It's terrible for you. You're going to make mistakes, and those mistakes are going to end badly. In this case, what I like about Medical Properties Trust is I think bankruptcy of this company is not even remotely on the table in the playing cards. These acute care hospitals, these master leases, the tenants pay rent, and if the tenants don't pay rent, the landlord replaces the tenant. There are some hiccups. Sometimes those hiccups take time, but I think this is extremely conservative. It's like a hot cold. It's an extremely risky conservative, extremely aggressive conservative situation. I don't think this is a bad bet, because 3,000 of these contracts have exchanged hands today, and there's a huge amount of open interest at some of these prices. So this seems to be a pretty popular one. The $4 strike price, much more than the $4.50. Again, this one could have a 8.5% yield, but much more likely to get triggered. This one has almost a 5% yield and seems to be pretty unlikely to be triggered. And even if it was, you're just buying a good company at $3.81, which is a fantastic outcome. So Medical Properties Trust, I would do that. I would write that put. I don't think that's a mistake. But again, this is not financial advice. Going down the chain to my next largest holding, go to Transocean. I think this will be a Trump beneficiary. I think it's a drill baby drill, because that includes offshore Gulf of Mexico. It's not bouncing along the bottom of its range, but its price is definitely not breaking out to new highs. So one of the problems when you have a market that's been everything's been breaking away is it makes it hard to write puts, because there could be a lot of mean reversion there, right? Like if I look at one of my paywalled companies like Douglas Elliman just had this huge run up on the news of the new CEO. I think that was about here. I mean, it's almost doubled from $1.40 to $2.80. It's come back a little bit, but if I sold puts here to promise to buy it at $2.50, well, I don't have a lot of confidence that there won't be some volatility and this stock won't trade down to $2 again. I think it's very possible this stock could trade down to $2 again. So I think this is, even though it's a company that I really like and I want to own more shares, I might have another chance to own more shares much cheaper than this. So this one does not have a chart that I'd be really interested in writing puts on. But back to Transocean, we don't have that breakout yet. We just have this slow grind where they have a $9 billion backlog. Last quarter, they were operating cash flow positive. They paid down some amortizing debt. The situation for them gets better and better as old contracts expire and new contracts are at higher day rates. So this one also looks pretty good fundamentally to write puts on, but let's see what people are paying for these things. Again, this does have weekly options, which is good, and it has 50-cent strike prices, which is good. I'll go out 1 month, just so we're doing apples to apples comparisons. I really like 2-week options. I could get paid. Now, what's not good about this one is the current stock price is in between option strike prices. $4.36 is pretty far in between $4 and $4.50. You get paid the most for selling an option when the current stock price is exactly at the strike price of the option. So if Transocean was currently trading at 4 or at 4.50, these prices would be better. So these are not fantastic prices, but I could get paid 31 cents today to commit to buy Transocean at $4.50. 31 out of 450 that's a 6.8% yield. That's pretty nice. Now, it's not, it also contains the bet that the stock price is going to go up. Not just that the stock price is not going to go down, but it's going to go up. So odds are when you get to the 20th of December, the stock price might still be below $4.50. If I go back to the $4 strike price, I only get paid 9 cents to do it. and 9 out of 450 is a 2% yield. And also, depending on which platform you use, you probably pay $1 every time you trade a contract. So it's actually going to be 8 cents instead of 9, even if you get that price. If it triggered, you'd be buying it at $3.91. And if it didn't trigger, you'd be getting paid less than 2% for the month. That's not super compelling, right? Those aren't fantastic yields, and you see the volume hasn't been anywhere near as amazing as Peabody Energy and Medical Properties Trust. Even though Transocean has a large market cap, it's a liquid stock. So fundamentally, I like it, but the prices of the options are not fantastic. If you wait a couple of days and this is trading either at 4 or at 450, and those prices are higher, I still think this is a great stock to sell some puts on. Just I'll wait for the prices to be better. And those prices might get better either because the VIX index, the volatility shoots up, or the put-call ratio, people are buying more puts, and that's going to be associated with the market falling a bit. So if there's a market pullback overall, you'll see the price of those options go up. We're not even at the 20-day moving average for the S&P 500, although we are at the past highs. It could fall from here. It probably will grind higher. You've got seasonality, you've got the Trump euphoria, you've got the market likes the new Treasury Secretary nominee. There's a lot of reasons why the market will, and the Santa Claus rally, a lot of reasons why the market will go up to the end of the year. I didn't even talk about tax loss harvesting. So stocks that have been down, there's a good chance they could keep on going down. Transocean is a candidate for tax loss harvesting. So that's another reason why this is not a smart put to sell right now. Going down the list, my favorite stock that I'm buying the most of right now, Finance of America Corporation. It finally had a solid quarter. Some of the residuals from its mortgage-backed securities finally hit book value. It wasn't cash yet, and the stock price shot up to 24 to 27. This is extremely high volatility. Now, high volatility means they'll pay you a lot for the options. This is a stock that I don't have a full position. I want to own more. So I'm willing to be a little bit more aggressive with this. And this high volatility means the options will probably have a pretty nice premium to them. But this chart doesn't give me confidence that it won't fall. You know, this stock price could be $15 a share again pretty quick. But that's not going to stop me, mostly because I genuinely want to own more, and I want to own a lot more. Now, this is a very thinly traded stock. The market cap is maybe a tenth of Transocean. 0 contracts have changed hands today. So this the bid-ask spread is wide. The day that this $1.89 changed hands, I don't even know what day it was, but that was not today. So if I tried to sell one of these, I don't even know what I would get. Could I get $2.50? Maybe. If I got paid $2.50 to sell a put for Finance of America companies at $20, what that means is if I was assigned that, I would essentially be buying it at $17.50 a share, which I think is a fantastic price, and I like it, and I would want to buy more there. If it doesn't get assigned, well, I get to make $2.50 off of risking buying it at $2,000. That's a 12% yield. I don't know if I would actually get $2.50. It could be $2.20, it could be $2.10. It's somewhere between the bid and the ask. The $17.50 strike price is no bid. There are no open interests on that. Now, if I were to put in a limit order, it might get filled because the algos would see it and jump on it, but there's no current bid. This is a no bid thing. So the thin liquidity is a problem. The bid-ask spreads become wide. You don't really know what you're going to get. But that's not going to stop me because this is a company that I'm accumulating the stock. I want to buy more. And instead of just buying it today, I'm selling some puts, I'm collecting some premium, and I'm just gradually buying more. And that might mean the stock price might run away from me. I own enough that I am not afraid of missing out. I don't have the FOMO. I'm not afraid of it running away from me, but I'm still accumulating. I still want to buy more. But that these options are no bid is aggravating, and the bid-ask spread is wide is aggravating. And if I go out to January, doesn't get much better. So if I throw in an extra month, if I do a 2-month option instead of a 1-month, there's still no volume today, but at least there's a bid for the 1750. You'd make about $1. So now it could fill somewhere in the middle here. And if it did fill somewhere in the middle, you'd essentially, you're promising to buy 100 shares at 1750, but you'd get paid maybe more than $1 to do that. So you'd actually be paying 1650. That's a fantastic price for this stock. Now it's tying you up for 2 months instead of 1 month or 2 weeks. It's a little bit longer term. And if you go out to February, now you're talking about 3 months. At 3 months, still no options have traded hands today, but there's a couple strike prices that are not no bid. You could pick up nickels in front of a steamroller and even promise to buy it at $12.50. Will the stock ever see $12.50 again? Anything's possible in the stock market, but you have a lot of resistance, right? You've got this 50-day moving average, about 14. The 200-day is still below $12.50, but there's going to be a lot of bounces. Bouncing off the 20-day moving average is very likely. Bouncing off the 50-day moving average is very likely. And one of the reasons it's likely is because so many people follow the technicals that they cause it to be a self-fulfilling prophecy. But the $12.50 strike price, I think there's pretty good odds that the stock does not fall below that again. For one thing, it was a past resistance, which can become future support. So if you want to pick up nickels in front of a steamroller and you say, hey, I want to make 50 cents or $50 by promising to spend $1,000 or $1,250 for something that I really am pretty sure is not going to get triggered, I think this one has a pretty solid chance of not getting triggered. I'm going to play at these higher strike prices where the premiums are larger, because I don't mind owning the stock. I don't mind owning it at $17.50, but have taken some money off the table. So call it, if you get paid the $1.20, you'd own it at $16.30, or you keep the $1.20 if it's not triggered. That's not a bad outcome to me, because, and if you read my paywalled articles, you know why I want to buy this thing so much. But this is not the perfect chart for it, but the high volatility makes the premiums very large, even on a day when the put-call ratio is low. So I do have some options outstanding for Finance of America companies because it's a part of my accumulation strategy. New Fortress Energy. This one is, I think this peak is when I wrote about it on my Substack, which, I hadn't bought any shares yet, and it crashed immediately afterward. I think the price that I filled was closer. I think this is where I bought. On the last earnings call, we've had 2 earnings of, well, this earnings call was an improvement over this one. This one was 125 million EBITDA. This is 175 million EBITDA. So I think we're in a world now of subsequently improving earnings. And I think this, call it $8.51, $8.50. This range seems to be the resistance. Could it crash below that? Of course, anything's possible. The stock market is a wild and crazy place. But I think next earnings will be a sequential improvement. So could you write puts on New Fortress Energy? It's possible. I'm not against it. Let's see what the strike prices and the premiums look like as I wait for the internet to load. Come on. Ever since Hurricane Milton, my internet connection has not been great. This is why I do a lot of recordings. I haven't done a lot of live interviews, because you saw the one where I was on with John Polomny. I had a terrible internet connection, and that was even before Hurricane Milton. It's been worse since then. Okay, New Fortress Energy. Again, this one does have weekly options. I wanted to show you that for Finance of America Corporation. Finance of America only has monthly, and they don't even have every month. So you can't do March or April. You can do February, May. But New Fortress Energy, it's a much more liquid stock. It has volume for next week. I'm just going to use the December 20th to make the comparisons more fair. Personally, I really like the 2-week time horizon. I think that the premium compared to the risk is really good over 2 weeks. I'd rather have two-week periods in a month than one monthly period. But just for even comparisons, I'll do 20th of December. There's volume, there's open interest, and the strike prices are narrow every 50 cents. For the 20th of December, you could get paid 65 cents promising to buy New Fortress Energy at $9.50. That means if you got triggered, you'd be buying at about $8.85. You could get paid 45 cents promising to buy New Fortress Energy at $9, and if that got triggered, you'd be buying it at $8.55. This one has a lot more volume. So I think a lot of people out there are saying maybe $8.50. That's about here. That's pretty much the floor. It's bounced off that a couple of times. So people are, other market participants like that strike price. They're comfortable getting paid 45 cents to promise to buy it at 9. If it got triggered, they'd be buying it at $8.55. And they think, yeah, that's in their minds probably as low as the price will go. If you do get paid 45, promising to spend 900, you'd be getting exactly a 5% yield. I should have been able to do that in my head. So this strike price is exactly a 5% yield, seems reasonably safe. 33 of those contracts have exchanged hands today. A few more contracts have exchanged hands at the $10 strike price, which is above the current price. So people are predicting the price going up over time. You know, that Trump, so we've got two things. New Fortress Energy is attached to natural gas. There's been news reports recently of a colder than average winter, but that shouldn't affect New Fortress Energy because their prices are all locked in. Well, not all. They have a lot of prices locked in. There is a world in which they could over-earn because of the cold winter, and that's that they're increasing capacity for their FLNG floating platform, and they can send that by boat over to Europe, where the Dutch TTF price is hitting new highs, I think, since the Ukraine war. So we've had 2 warm winters. If we have an average or a cold winter, natural gas business will be booming. So 50 of these contracts at 10 have changed hands. You could get paid 95 cents. Getting paid 95 cents to risk $10 for a month is a 9.5% return. But a lot of that is because the stock price you're predicting is above the current stock price. And if it doesn't reach that, you would be buying New Fortress Energy at $9.05, which isn't terrible. So if you get triggered selling a put at the $10 strike price, you'd be buying New Fortress at $9.05. If you sell it at the $9.50 strike price, you'd be buying New Fortress Energy at $8.85. And here, if you sold a put at the $9 strike price, you'd be buying New Fortress Energy at $8.55. It's just a matter if you want a 5% yield, a 7% yield, or a 9.5% yield if you don't get triggered on it, if you don't get filled. So again, further down, you're trying hard, you're accepting less money to try and not get filled. More aggressively, it's when you're building a position and you're kind of indifferent if you get filled. So New Fortress Energy, the chart is good, the prices are good, I like it. For my readers, when I wrote about it at $25, I think you'll see 5 years from now, even if you bought in at $25, fundamentally it was still a good price. But it became a pound the table, buy as much as you can down here at $8 and $9. I think that this company is fantastic. I think, you know, bankruptcy is not in their future. There are stocks that I do buy that their future, things could go very bad for them. So I'm not going to sell any options on the Container Store, right? The Container Store, now their fundamentals, especially if you look at their operating cash flow, I think is very good, but there is some chance that they're not going to make it. The Container Store is much riskier than a lot of other things. It might not even have options, is it? Yeah, so the Container Store is so small and so thinly traded, there are no options for the Container Store. But this is an example of a stock that I would not be selling puts on. I own some, I might even buy a little more, but there, you know, this one could be a zero, and I typically try to avoid stocks that could be a zero. I don't think it's a zero. I like it, but it could be a zero. ACDC. So this is one where on the Trump news, which I think is about here, it was up 12% that day on the Trump news. It's starting to break out. So selling puts on something that's above all of these trend lines. Now, things that are up with momentum, they might keep on going up. But, could this stock price fall back to $6 to $5.50? I think it's breaking out and it's on a new, higher lows, higher highs. I think this is a new positive trend line. But it's not exactly the sort of thing I want to sell puts on, because it could still come crashing back down. And this one does not have weekly options, it only has monthly. The strike prices are a little farther away. Sometimes they're $1, sometimes they're $1.50, between $7.50 and $9. It's not huge volume. You have 20 contracts trading hands today at the $7.50. So if you get paid 45 cents promising to buy it at $7.50, you could get filled and have bought it at $7.05. Now, if you don't get filled, 45 at a $7.50 is a 6% yield, which is a very nice yield. But if you do get filled, could this stock price dip below $7.05? Yeah, it's spent most of the time period since August below $7.05. It could easily fall back there. It has the narrative, right? It's a Trump trade. It has the exposure to, with this cold winter, with the demand for natural gas and natural gas prices going up. If the winter is cold, it's hard enough to predict the market, trying to predict the weather. But some meteorologists are predicting a colder than average winter. I'm not going to sell any options here. I like the, you can really get burned with options so badly. I would be selling it when it's much closer to resistance levels. Let's see. Vermilion energy is starting to break out a little bit too, because of this possibility of a cold winter in Europe. So you have, this range that it's been in since August, where it's been, below $10 for most of it. It's cracking above. It just bounced off the 50-day moving average, which is not good. But it's cracked above a lot of things. Oops, sorry, this is the 200-day. So it bounced off the 200-day. It's well above the 50-day. Vermilion's trying to break out. Could it come crashing back down below the $10 range? Absolutely it could. Let's see what the prices on the options look like. It's not weekly, it's only monthly. The strike prices are very far apart, 250 apart, but it's close to the 10. No volume today, but they're not paying you much. They're going to pay you 15 cents to promise to pay it $10. That's a 1.5% to promise to buy it at 10 for a month. So the yield on this is pretty low. And I don't know if that's just the person on the other side of the bet, the person who would be buying this from you. They're not interested in buying it. There's more interest in selling it. So I think that the narrative with natural gas prices going up in Europe, you've got the new energy secretary under Trump. You've got Trump saying drill baby drill. The dominant narrative is it's going to be good for energy stocks. Whether it ends up being good or not for energy stocks, nobody really wants to buy these off you. 1.5% is not an exciting yield. It's one thing to pick up nickels in front of a steamroller. I don't want to pick up pennies in front of a steamroller, because if you get filled on this, you own an awful lot of it, right? I do already own a lot of Vermilion. I don't want to own that much more, especially if you're not getting paid to take that risk. But it seems like the market's pretty enthusiastic about, no, the stock prices haven't gone up much, but the fact that nobody wants to buy a downside protection on this thing, that the bid is so low, is pretty telling. There's not a lot of money to be made on that bet. Let's see. Sibanye Stillwater. On my Substack write-up, it's called Why I Love Sibanye Stillwater, and therefore I hate myself because of all the pain that it causes. This one, it doesn't have weekly options, which is interesting because its market cap is large enough to have weekly options, but it's also a foreign ADR, American Depository Receipt, so I don't know what the float is for the American side or how much is South African. This yield, instead of making 15 cents on a $10 bet, you're making 15 cents on a $4 bet. That's a much higher yield. 15 cents on $4 is 3.75%. So if you promised to buy Sibanye-Stillwater at $4 and you got paid 15 cents to do that, if it got triggered, you'd be buying it at $3.85. And if it didn't get triggered, you'd be making a 3.75% return on the money that you're promising to do that with. And if I look at the chart, where does $3.85 come in? Technically, there's a lot of support there. You know, $3.85 this is a pretty safe bet if you want to, and 3.75% is not a terrible yield. So yeah, this one's not a terrible one for that. At some point, you know, the demand for autos has got to pick up. I don't know if that's going to be in year 1 or 2 or 3 for Trump. And also, I've heard that there's a pretty large amount of stockpiled platinum and palladium to burn through. So the demand for cars could pick up. It could still take a year or 2 after that for platinum and palladium prices to respond. I still like Sibanye-Stillwater. I still own it. I'm still very, very slowly accumulating it. This is not a terrible option. Now, there are other things that I like better that are higher than 3.75%. This one is a relatively safe one. Oh yeah, and volume, it's had 126 contracts change hands today. So it's there's a lot of people out there thinking this is not such a terrible idea. Again, not financial advice, do your own due diligence, and also most people should not trade options. The funny thing about that is you have passive indices beating active management. They say, well, therefore everybody should be passive. There is a transfer of wealth from people who buy options to people who sell options. People that sell options, on average, make money off of people who buy options. But then they don't say, well, therefore everybody should sell options. That would be crazy. You have this long-standing thing in philosophy that you can't get an ought from an is. You can't tell people what they should do just because of how things are. But there's this dominant narrative, this specious argument that everybody should be in passive indexing because it beats active management. Well, that's just like saying everybody should be selling options because it beats buying options. It doesn't follow from that, right? It's a specious argument. You can't get the ought from the is, but there's this dominant theme that everybody should be passive, and it's just not true. But yeah, most people should not sell options. If you do sell options, you're going to get burned. Let's see. Douglas Elliman we looked at. It's run away. I'm not going to sell any options on Douglas Elliman. I can look at the prices, right? I could get paid 10 cents to promise to buy it at $2.50. If it got filled, I'd be buying it at $2.40. But what are the odds I'm going to have a chance to buy it cheaper than $2.40 anyway? Pretty good. I mean, it might just keep on running, but it's not the most attractive option to me. Also, 10 cents out of $2.50, it's 4%, and some of the options are a little higher than that. It's not terrible yield if it doesn't get triggered, but I think odds are good that it'll get triggered. That it can spend some time maybe falling back down to the 20-day moving average, and when it starts hitting the 20-day moving average, I would accumulate more Douglas Elliman. I would sell an option, but not when it's not when the chart looks like that. Equinox Gold. Gold is having a rough day. In fact, let me come here to GLD. This isn't the gold price. This is a gold ETF. But on the Trump news, gold crashed, then it rallied, and just today, it's down about 3% on the day. I don't think people know what gold is going to do under Trump. I don't think Trump is going to fix the US dollar as a reserve currency. I think central banks will keep accumulating gold because once the US froze Russian reserves or seized Russian reserves, the rules-based order ended, and everybody knows that. There's no trust. There's a multipolar world with no trust. So I think in the longer run, gold is going to be strong, but in the short term, in the first year of Trump's presidency, the second year, and who knows, it could go anywhere. But if I look at the gold miners, this is not a terrible place to accumulate Equinox Gold. I would not be against that, but let's see if anybody's willing to pay me to do that. The options here, now there's no $5.50 strike price in December. There's only a $5, and you're only getting paid a nickel for that. If I go out to January, there is a $5.50 strike price for January. Now you're looking at 2 months. But for 2 months, you can get paid maybe 37 cents off of 550, which is 6.7%, but it's for 2 months. So it's, it's only a little over 3% a month. But if you promise to buy Equinox Gold at 550 and you get paid 35 cents for that promise and you get filled, you're buying it at 515. And I would buy Equinox Gold at 515. If I go back to the chart, at 515, you're in a range where, yeah, that's a nice support line. It's bounced here, 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 here. So past support, yeah, the idea that Equinox Gold is going to fall below 515, it's possible, but it's bounced off of that line a lot of times. It's only broken below it in August. Aside from that, it's been above that. So from the technicals, having a break even at 515 is very comfortable. Making 3.5% a month for the promise. Again, you have to go out to January, but getting paid 35 cents to promise to buy Equinox Gold at 550, it's not terrible. I don't hate it. Let's see. There's other smaller names that I'm accumulating. One of the problems right now is so many things, the prices have really started running up. I don't sell options on things that are not currently profitable. Something like Cardlytics, it's a stock that I want to accumulate more of. It had this little false breakout and crashed back down. It looks like it's trying to break out again. But their market cap is really low for the kind of business it is and the opportunity that's there, but it's not the incomes on it. I'd rather have something. I'm not going to sell options on a melting ice cube, and right now their net income, and there's going to be adjustments in there, so I'll probably want to go down to cash flow. Well, revenue will kind of tell you the trajectory, but they did just sign a new contract, a new client for American Express, so the revenue should be improving. If I go down to cash flow here, just want to see if they're operating cash flow positive. And barely they are. So for a company, as long as they're operating cash flow positive, preferably net income positive, free cash flow positive, not including debt accumulation. But I'm not super excited about writing puts on Cardlytics. I don't think I would do that. I would want to look for something that's net income positive, that has, strongly growing revenues, that has, operating cash flow, large operating cash flows, even if they have a net income negative, because sometimes you have one-time charge-offs or write-offs. Cardlytics is a stock that I'm buying, but I'm not going to write options on it. I don't even know if they have options. They do, but I'm not touching them personally. And you could if you want to, but there's in Benjamin Graham's security analysis, he argued that bonds were the investment of choice for the professional investor. And the thing about bonds is that the defining characteristic about them is they have a limited upside. Well, selling puts also have a limited upside. Selling puts, it's in some ways very similar to bonds, as opposed to picking stocks. When you're picking stocks, you have an unlimited upside. When you're picking stocks, they could be lottery tickets. Cardlytics is like this. It could be a 50 bagger if they do what they need to do with the company. But when you're picking stocks, if you get one 50 bagger and you have, a few break evens and you have 3 go to 0, you've done really well. But if you're buying bonds, you can't really have any go to 0. So the mentality shifts. When you're buying bonds, the mentality shifts to, okay, I'm only going to buy bonds from companies that I know are not zeros. When you're buying stocks, you can play that game. It's like the difference between some fish, they lay their eggs, in a coral reef and they protect them and they fight them. Marlin and swordfish and mahi-mahi just scatter their eggs to the ocean. Say, look, I laid 100,000 eggs. 3 of them are going to grow to maturity. as a stock investor, you could do that. Say, like, I'll put a 0.5% position in a bunch of things, even though some of them are going to go to zero. As a bond investor, you can't do that. As a bond investor, you have to only buy things that are not going to zero. And selling puts is much more like being a bond investor. So in Benjamin Graham's security analysis, he talked about that being a negative act. You're not choosing what do I buy, you're choosing what do I not buy. What do I exclude? What do I cross off my list? So even though as a stock investor, I am buying some Cardlytics, as an investment with a limited upside, as somebody who's selling puts, Cardlytics gets crossed off my list. It's just too dangerous. It could be a zero. And I don't want to commit to buying a bunch of something that could go to zero, even if as a stock investor, I would buy a little bit of it. Take a quick look at Portillo's. Portillo's had this massive crash and had no love at all on the Trump rally. Even though I think that their business is fantastic and they're doing fine, I think this is one of those moments where, you know, it's below the 200-day average, but it's going to be a strong stock that bounces back above that. So, I mean, is it going to crash back to $9 a share again? I think next quarter they're opening 5 new locations out of 89. I mean, their growth is aggressive. They're still profitable. So a company that's profitable, right? The PE ratio isn't cheap, but they're profitable. So this doesn't get crossed off my list. This is something that quarterly cash flow, operating cash flow. Now this one is spending a lot of money reinvesting and opening new stores. Did I get, yeah, cash from operating. So 30 million a quarter in operating cash flow. That's fantastic. Now they're spending probably 60 million a year on opening new locations, but they're making 30 million a year in operating cash flow. So I would sell puts on that, knowing that, you know, over time they're going to do a fantastic job. The chart is, you know, not telling me much of anything. And I'm not as good at technicals. Mitch isn't here to give me a second opinion. So the chart isn't fantastic, but depending on the price of the options, this is a stock I want to accumulate, and I want to accumulate aggressively. If I sell a put at 11 and I get paid 35 cents to do that, the yield on that is a little over 3%. Not fantastic. If it gets triggered, then I bought it at $10.65. But I'm in the accumulation part of my Portillo's position. I want to own more. I don't have a full position. Am I happy owning more at $10.65? Oh, heck yeah. So I'm going to sell that put, but I'm going to sell that put knowing that there's very good odds it gets filled. And if it doesn't get filled, well, I'll keep 3% and I'll be happy with that. That's fine. But I'm in the accumulation phase for this stock. But it's if you want to play the game where you're only trying to write puts that don't get filled, this is probably not the thing, but it could be. I'm not going to go through every name on the list today, mostly because so many things have broken out. Because the market's grinding higher with the Santa Claus rally and the Trump trade. But I looked through a few things, and again, selling options, not only is this not financial advice, don't do it. You're better off not getting involved in this. If you want to make this, you know, a very, very involved hobby, or your full-time job, you spend all day thinking about this stuff, that's one thing. But if you want to casually be involved in options, that's a very, very bad idea. There is a steep learning curve. The mistakes are expensive. Don't do that. But I had subscribers ask me to talk about options, to tell them what I mean when I say that I'm rolling puts or writing puts. And that's what I'm doing, is I'm trying to raise money by selling the promise to buy more of a stock that I already believe in because I've done the fundamental work. And I would never do this if I did not primarily start as a fundamental analyst, that I'm doing this for businesses that I do like. I'm doing this for businesses that I want to own more of. And if I don't get filled on it, well, I'll take the cash and use that to buy other stuff. So it's a form of leverage, and it's a very deceptive form of leverage that can really burn you very, very hard. So again, not financial advice. And I'm honest and serious when I say, just don't do it. For most people, this is, if that's not the part of the division of labor that you're in, if you spend all day as a dentist pulling teeth, or you're taking out appendices if you're a surgeon, you don't have the time to learn this stuff, right? This is a whole different branch of the division of labor. And I'm not trying to be snobbish and say, oh, I can do this and you can't. Just saying that, if that's not your part of the division of labor, if that's not your day job, this is a really steep learning curve, and you can get burned really, really harshly. So anyway, thank you for watching. I hope you guys are having a really good holiday season. We've got Thanksgiving coming up and Christmas. I hope we have a bit of a Santa Claus rally. And I think January is going to be exciting, because January can be a time when there's enormous portfolio rebalancing, where people can reevaluate what are going to be the themes for 2025, because they can sell things that trigger a taxable event, but still have a whole year to reinvest the money before they pay taxes on it. So I'm anticipating there might be some tax loss harvesting coming into December, but I think January is going to be a very exciting month. Or not, we'll have to see. Anyway, thank you for listening. Have a great day.